With AI hype driving record corporate bond issuance, how do you separate the winners from companies at risk of disruption? Hi, I'm Maria Colangelo. In this video, we'll discuss why today's bond pickers market is creating opportunities in investment-grade credit, how we're navigating geopolitical risk, and which types of companies are positioned to win or lose as AI reshapes the corporate landscape. Last year, everyone expected a market with clear winners and losers, but that dispersion never fully materialized. This year, it's different. We are seeing much more meaningful separation across sectors and issuers, and that's what's turning 2026 into a true bond pickers market. AI is a big driver of that, creating divergence even within sectors, particularly in technology, where business models and balance sheets are being repriced in very different ways. You are also starting to see it show up in more subtle ways, like in parts of private credit, where direct lending exposure to smaller software companies is leading to spread widening. And in investment grade, heavy issuance from hyperscalers funding AI is pushing spreads wider, creating dislocations even among high-quality issuers. That's the opportunity. We're seeing attractive entry points emerge in high-quality names where spreads have widened for technical, not fundamental reasons. That includes selective hyperscalers where strong cash flows remain intact despite heavier issuance. Areas like hardware and semis that may be better positioned in the AI build-out, and financials where balance sheets are significantly stronger today after years of de-risking. So you're getting paid more to own fundamentally strong credits, and that's where active selection can really add value. So for advisors, the takeaway is straightforward. This isn't a market to own broadly. It's a market where security selection really matters. Investment-grade yields are back above 5%, and that changes the conversation for fixed income. Right now, both fundamentals and demand are working in investors' favor. On the fundamental side, earnings remain strong, margins are expanding, and balance sheets are in good shape, which supports credit quality and spreads. At the same time, the recent move higher in rates has pushed all-in yields to much more compelling levels. You're now seeing high-quality bonds yielding closer to 6%, which is attracting both domestic and global demand. That's what makes this environment so compelling. You're getting attractive income from high-quality credits with fundamentals that remain solid. So if markets remain relatively stable, income, not price appreciation, is likely to do the heavy lifting in 2026. And that makes investment grade a very competitive alternative to cash. Notable downside risk to credit markets due to the Iran conflict are twofold. One, continued higher inflation, and two, potential for a global recession. For advisors and investors who are highly concerned about these potential risk factors but still want to capture attractive carry, we would recommend an up-in-quality bias out of BBB cyclicals into selective hyperscalers for minimal spread and yield give-up. Hyperscaler spreads have widened meaningfully on the back of heavy issuance to fund high CapEx needs. And while the jury is still out on AI monetization, Latest survey data from early AI adopters shows significant productivity increase in small-scale applications across various sectors, anywhere from 15 to above 50%. So, while we are in the early innings, initial AI impacts show potential, and hyperscalers are well positioned to benefit. AI isn't just a technology story. It's one of the largest capital formation cycles we've seen in decades. We're talking hundreds of billions, approaching $1 trillion of investment to build out AI infrastructure. That's driving a wave of issuance across fixed income markets, across sectors, currencies, and structures. And that's where differentiation really matters. At Vanguard, we're built for this environment. We have the scale to participate in these large, complex deals, and just as importantly, the cross-asset expertise to evaluate them holistically. That means bringing together perspectives across investment grade, high yield, and structured credit to assess everything from data center financing to AI infrastructure more broadly. So it's not just about accessing the deals, it's about underwriting them correctly. And in a market this complex, that's what ultimately drives better outcomes for clients. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.